Before you hop into the DeLorean, though, remember, this is still the same old rotating market. There's not enough money in equities to move the whole market at once. The rally in these classic senior growth stocks come at the expense of high flyers like FANG and the Cloud Kings. Witness the pullbacks of Adobe, VMware, Salesforce. That's a big difference from the 80s when Kimberly-Clark, Coca-Cola, Procter & Gamble, Colgate, PepsiCo, Merck, Schering-Plough, Pfizer were the real growers. And the tech companies like Motorola, Texas Instruments, and IBM took a back seat in terms of growth, although Texas Instruments reported an awesome number this very evening. But I think there could be more money going the way of the Cokes and Kimberleys because this very evening we also learned that the Justice Department is investigating the giant tech companies like Apple and Amazon, Alphabet, Facebook, see if they're stifling competition. Now, this is a change of heart from the department, which had been a staunch defender of these companies' abilities to compete globally. But now they will have to face scrutiny that could stifle their own creativity. That's my view. I don't mean to be too cavalier, but you know what? Ultimately, this is going to prove to be a buying opportunity. Why? Because the wheels of justice grind so slowly. So what does the reversion to the healthy consumer packaged goods stocks today, what does it mean for the market? What does it mean for you? First and foremost, you've got some fallback stocks, some very good stocks to fall back on if this market stumbles. As freight costs and commodity prices keep coming down, as advertising becomes cheaper thanks to more targeted digital ad buys, the gross margins for these companies will continue to expand. Normally, I'd be worried about encroaching private label brands, the knockoff merchandise, so to speak, but it just hasn't happened so far. It's on all the conference calls. People, wait, it hasn't happened. Because the consumers feeling flushed are staying with the name brands, particularly all that innovation. Second, if the Fed does cut short-term interest rates, these consumer packaged goods stocks will have even more competitive yields versus the CDs that so many of you have been hiding in. Third, remember, these are slowdown stocks. If we get a weaker economy, as people keep saying, they're still going to be able to make the numbers, and the shares will become a lot more attractive. Fourth, Coca-Cola and Kimberly are addicted to returning capital to their shareholders via dividends, via buybacks. If the companies keep putting up fabulous results, I think management will be tempted to boost their payouts and the repurchase programs. That's fantastic. Fifth, on any breakdown in the trade talks with China, which I expect, don't forget these two companies do tons of business in the People's Republic. They're not the most obvious China plays. They'd absolutely benefit from any progress here because progress makes it less likely they'll be tariffed or boycotted or even banned into oblivion. Don't think it'll happen, but trade talks go well, you'll make money too. Finally, even though their stocks have run a great deal, Coke more than Kimberly, Wall Street still hasn't really gotten behind them. Actually, it's kind of fought the increase the whole way. I do expect multiple upgrades from both these names, even though they've run tremendously of late. This is really the first quarter where these consumer packaged goods companies have the wind at their backs. They've been raising prices repeatedly to offset the rising raw costs. But for the most part, that barely covered the increase in commodity prices. Now those costs are coming down. But the prices you pay at the store, They're not going down. Boom, instant margin expansion. Their targeted ad spending via Alphabet or Amazon or Tmall or Facebook lets them reach the right audience for less money. It's all falling into place. Can you imagine if the dollar ever went down? So let's stop complaining that stocks have run up too far too fast. Let's stop with the endless parlor game about whether the Fed's going to raise or not cut or raise this or that. I don't give a darn. The bottom line is that these consumer packaged goods stocks haven't run that much versus the techs. They have incredible pricing power, vast untapped markets overseas, and terrific dividends. If I'm right that this is like the 1980s all over again, it means the likes of Coca-Cola and Kimberly-Clark have a lot more room to run.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.